Train Justice episode 580. I'm joined with my brother Matt, sponsored on this podcast by the good folks, which include us at Tackle Trading. Tackle Trading is an amazing community. We just put out a fantastic newsletter, world-class newsletter. We've been saying that newsletter is the reason to join, and then you stay for the community, and there is a lot of truth to that. 15-day free trial, great community. Come join us at Tackle Trading. And Matt, you put in a lot of work on that newsletter. A couple months ago, you said to me and the other people at Tackle Trading, it's like, listen, we're going to put out a world-class newsletter. Now, we had been putting out a really good newsletter, but you said we're going to put out a world-class newsletter. And it is certainly heading in that direction, Matt. It was fantastic. I read it as a consumer this weekend when you put it out, just as a trader. I was like, holy cow. I just enjoyed it thoroughly. Matt, how are you doing?
Doing good. I am doing good. I'm excited to be here with you to record another amazing edition of the Train Justice podcast. And yeah, you know what? I rather enjoy putting the newsletter together. I've been enjoying the process of the writing the blog post in the newsletter, the updating of the earnings forecast. Every single week I write about a technical update in the market. I tell that technical story over time, and so you can read it like a story that is told over time. I always do an earnings update talking about the best earnings reports of the week. Obviously, Nvidia this week was a rock star, but there's always forgotten children out there that we want to talk about. And I do some quick hitters from a bull and a bear perspective.
I love the quick hits. Holy cow!
I'm a fan of the quick hits too.
I'm going to ask you to put more quick hits in. I love them.
Quick hits they're there for quick hits. for is good, but and then on the third topic, I always talk about some topic that's on my mind from an educational perspective, information perspective, an awareness. I want to put this on our community's radar. And for example, this week I talked about the halo effect of Nvidia, and I wanted to teach our community both what a halo effect is, which is basically a cognitive bias that we have towards an individual company and the downstream impact that can have on a space. And a lot of times when people think about the cognitive bias of halo effects, they see it from a negative perspective. I don't see it from a negative perspective. I see it from an understanding of the downstream impact of a general in the market, and that is Nvidia. And so, and then obviously we do sector rankings and go through our rankings and talk about the indicators, specific charts that matter to the market. We do an economic update, and then we obviously end on global markets. We do some videos that explain the sectors and the markets and the global markets. So it really is, and the design of the newsletter is a one-stop shop to get everything you need to be informed like a Wall Street pro is on a week in, week out basis with the information you need to execute your trading systems on a day in, day out basis during the week. So love putting it together. Hope our community truly does enjoy it. And if you are looking for a community and a great newsletter to make sure that you are staying on top of the market on a week in, week out basis, the Tackle newsletter, there's some great newsletters out there. I'm not sure there's a better newsletter than Tackle Trading's, and I know there's not a better newsletter for the cost.
Yeah, no, absolutely. It is just genuinely because you forget things, Matt. Like you, even if you are actively in the market, you not only forget things, you miss things, and the storytelling aspect of it is just you've done fine work in being the lead on this. And of course, the story of the market this week, PMI numbers notwithstanding, we'll talk about them here in a second. Nvidia, story of the week, story of the quarter, story of the year, might be the story of the decade when we're all said and done.
I think it's the story of the decade, and we're
seriously, right?
For a year and a half, I've said this Nvidia AI saga is a decade-long saga. I've put together AI watch list, AI newsletters, PDFs. We've done AI webinars in our pro membership. I've done multiple different events where I'm talking about AI. So Yeah, I certainly do think the Nvidia story and the impact downstream on Nvidia and semiconductor companies, semiconductor infrastructure companies, software companies, the generals and the indirect impact that, you know, the AI build out and the infrastructure that goes along with that is going to have over the next 6 years, puts any other comparable environment historically to shame.
Yeah, I know. I've started to joke to you. I was like, "Hey, you're the AI guy." Like
I don't like being cornered in anything as a
I
guy.
I know you don't, but I'm having fun with it, and because it makes you uncomfortable, I'm going to keep doing it.
Man, I don't
But
like
you
it,
know,
but I do know.
but this the plain and simple fact is, Matt, you presented at a panel discussion a couple of weeks ago. You've started to get invited others, and the plain and simple fact is, you are approaching AI from a market perspective that nobody else is doing, and kind of just becoming kind of a leader in discussing this kind of you're ahead of the curve on this one, bro. Just deal with it. You're gonna be you're the I'm gonna just keep calling you the AI guy. Not a
Call me
bad
whatever
title,
you
dude.
want. I just like informing people in our community on what's happening in the financial markets, and this AI storyline over the last 2 years has caught my attention in a way nothing else has, other than gold analysis and the historical understanding of why we need to invest in gold. I think there's obvious reasons to focus on the value side of things and the growth side of things. I've never seen a better argument to invest in gold as we've seen in the last year and a half, and I don't think I've ever seen a better growth argument than what the AI space and specifically what Nvidia has done in the AI marketplace and the halo downstream impact on that. I've never seen anything like it in my career.
Yeah, I know. Listen, it's got legs. It's got legs. Let's
It's
get to
got
this.
days, bro.
Let's get to this fantastic earning report. Not a lot to nitpick. I try on all of these because I'm a contrarian by heart. I'm like, oh, and I just couldn't find a damn thing. Just nothing.
Well,
Like it just was
there
a
wasn't
fantastic.
anything.
Like it was just fantastic.
I think if you wanted to make an argument against Nvidia, it would be on the slowing momentum side of the equation. And I don't think it's a great argument, quite frankly, because I think it's very well known that as Nvidia grows and grows and grows, that the larger they get, the harder it is to kind of capture that type of velocity from a growth perspective. You're talking in the last year, a company that went from 6.5 billion revenue in the quarter to $26 billion revenue in the quarter. A very impressive 262% year over year growth. You're talking about a company that had an expectation of $5.55 EPS that came in at 612. That's only a 5% beat, and that 5% beat is less than what the average beat is in the marketplace. So if you wanted to throw a little bit of cold water, you could be like, yeah, but Matt, it only beat at 5%. We have, half the market beating it at a better rate than that. And I would say to everybody in the world, you don't understand what the expectations for Nvidia versus all those other stocks were. Nvidia was upgraded numerous times coming into the earnings report, whereas everything in the market was downgraded coming into earnings season. And so it's an apples versus orange comparison in my estimation. But that would be the argument, is that as Nvidia goes higher and higher and higher, it's inevitably going to slow down, both from a technical perspective as well as a fundamental growth perspective. And I would say yes, but in the quarter coming up from a guidance perspective, in the last 3 months, they've seen 100% increase in their forward-looking guidance. And so it's going to slow down. And eventually Nvidia is going to become a cyclical component of the semiconductors and not the general of generals. But is that this quarter? No, that's not this quarter. And there were people stating that it was going to be this quarter, and it's not this quarter. There were people stating it was going to be last quarter, and it was not last quarter. They were stating it was going to be a quarter, 3 quarters ago, and it wasn't that quarter as well. And I don't think it's going to be next quarter, as Nvidia also increases their EPS and revenue guidance in this earnings season as well. And so that would be the argument you make against Nvidia, is you're just going to see it slow down this type of growth to the point where it becomes a cyclical component of the semiconductors. And I certainly believe that's going to happen. But the question, and I do believe the debate, and where I would disagree with others, is I don't see that in the next 3 to 6 months. It could have happened in the back half of 25, certainly. But there's also other things we are not familiar with in this AI saga that are going to happen in the next year and a half that could accelerate the growth, quite frankly. And so I think there's a lot of variables on that side of the equation that could offset the slowing of this growth. But that would be the argument you want to make against Nvidia. I just don't believe in that argument. I think the growth is here to stay for at least a while, and Nvidia is going to be a leader in this conversation, not just in the next couple quarters, but over the next 10 years. I see Nvidia being a leader in this conversation.
Yeah, no, and nothing excites a trader like a stock split, especially on a higher price stock. It doesn't make it cheaper, but it can make it more tradable, right?
Well, it's really smart by Nvidia, though, and this is what smart companies do. This is what smart companies do. They get in front of the curve for the traders that trade their companies. Nvidia understands this. Other companies do not. When you talk about a company that gets above $1,000 a share, it's not that the split changes anything fundamentally towards Nvidia. It doesn't change a stinking thing fundamentally. It doesn't change the market cap. It doesn't change the PE ratio, doesn't change the PEG ratio, doesn't change anything fundamentally about the company. But what it does do, and what smart companies like Nvidia do, is they get in front of the curve because they know what their growth this year has done. What their growth this year has done, and it's beyond impressive, but what it's done is it's removed Nvidia from certain trading systems that rely on certain share prices. And then if they have any expectation of ever getting into the Dow, they need to make sure that their share price equates to what the Dow is looking for. And the Dow's not looking for $1,000 stocks. The Dow's looking for $100 stocks. And I'm not saying that the Dow is going to invite Nvidia and replace Intel, for example. It could occur, probably a smart decision by the Dow, but there's reasons smart companies like this get in front of the curve. I see their 10-to-1 split as a extremely good decision out of Nvidia.
In fact, the only criticism you had in conversations with this week is you're like, I wish they would have done 20. I think 20-to-1 would have been smarter.
It's the only thing I disagreed with on their entire earnings report. Increasing their dividend
was your nitpick.
That was my nitpick. But it's a strategic error. It's a strategic error because what they're not taking into account
is that they're going to go
put it like this. To understand this, Apple many years ago was a $650 company. And Apple many years ago, this is back in 2013.
Yeah, this is a decade ago.
Yeah, this is a long time ago. But Apple, it became extremely difficult to trade Apple for a lot of different trading systems. And Apple decided to split 7-to-1. And they split 7-to-1, a very random number at 7-to-1. And everybody's like, why are you doing 7-to-1? And I'm like, I know exactly why smart companies split 7-to-1 on a $650 company. It's because they want to get underneath a certain price threshold from a behavioral analysis perspective. And Apple wanted to get underneath 100 shares. And so I'm willing to bet Nvidia was staring at a $950 stock price, probably made the decision when it was around $900, and they were anticipating a bump up on the earnings report. But the 10-to-1 split would have put them underneath that $100 price point. And that's my only strategic concern. It's not even a concern. It's not even a flaw. It's just something I would have done differently, is split 20-to-1 to take into account, because I don't think they took into account what the market's reaction to their split and their earnings report was going to be. And so I do think they will regret that down the road when Nvidia splits again.
Yeah, no, it's obviously
thought they should have done a Google split. Thought they should have done an Amazon split.
There's a lot of places to go off this Nvidia, right? We could talk, and we're going to talk about a couple different angles, but let's start with the blended growth. I want to see some a little bit of streak going. Earnings season started one place, and the overall numbers when they put this one in the history books have just gotten better from a blended growth perspective, haven't they?
Well, and yeah, it's been a streak. Four weeks in a row, we've seen an increase in the blended growth. You can't tell the story of the market. And, for example, we were talking about the newsletter, Mark, and, over the last 3 weeks or 4 weeks, I've detailed the pullback, the recovery, the confirmation that we needed to see on a multiple time frame perspective. And now we're right back up into those all-time highs. It's been a really good month in the market from a bullish perspective. But is that simply because the market found technical support at the 20 weekly moving average? That's part of the story. Certainly, that puts a stopping point against the volatility in the market. And so when you're looking at the S&P a month ago, and you're like, "Oh, technically, you've held the 20 period moving average. You held that 5K level. That's a really, really good step in the right direction when you're looking at that technically." But that's only support holding. Support's not going to continue to hold unless this blended growth improves. And so as the technical environment improved, it was on the backs of the fundamental environment, and the blended growth went from 0.5% over the last 4 weeks, where we were at that 20 period moving average, to now at that all-time high. And in the same time frame, you've had blended growth go from 0.5 up to 3.5 up to 5 up to 5.4, now up to 6%, with the positive take on both there's a few good reports. PDD was a good report that didn't impact the S&P though. ELF was a good report. Nvidia was a decent report. And because of those decent reports, you basically saw blended growth go from 5.4 to 6%. Now, for those of you that are unfamiliar with blended growth, and we look at blended growth from an EPS perspective, you can also do it from a revenue perspective. But blended growth from an EPS perspective, going back to the streaks, Mark, this is going to be what, the second consecutive quarter we've had positive growth on the S&P, or the third consecutive quarter we've had positive growth on the S&P. And so we kind of got that major league streak going right now. It's a good EPS conversation, and it's on the backs of the blended growth. But what the blended growth does is it takes expectations coming into earnings season, and then as we get the actual numbers on an EPS versus the expectations of EPS, what that does, it allows us to update that blended EPS growth number in real time. Now, we're talking earnings here. Earnings is a very important conversation to understand. For the pro members of Tackle Trading in the Coaches Show this week, I'm going to start a 2-part series on understanding earnings, and we're going to get into it from not just an understanding the raw numbers and interpreting those raw numbers. We're going to talk about it from a complete perspective. What happens with volatility, the trading strategies that you apply going into earnings, trading strategies that you apply coming out of earnings, interpreting the earnings data, interpreting the gaps that occur in earnings season. We're going to do basically a class over the next two coaches shows, understanding earnings. And again, that's another reason why you want to join Tackle Trading, because not only do you get that amazing newsletter, which companies like Tackle charge more just for that newsletter, you also get the Coaches Show, which we put a tremendous amount of education in every single week.
Yeah, no, absolutely. All right. Does this bring, because one of the things I read in reading the newsletter this weekend is one of the things you put is, sector performance. It's a nice little graph, tells me what sectors have been doing lately. I saw tech up here.
Mm-hmm.
I saw everything else in the red on the week. And we'll talk about the volatility that hit on Thursday here in a second. Does this bring the tech trade back, right? Where tech becomes leadership.
Well, I think it does.
I think it does too.
I think it does.
Which is why I asked the question. I want a confirmation.
I knew where your head was at on that one. When you're looking at kind of the performance right here, I think it tells a pretty compelling story here that builds into a confirmation on an argument. In the last day, right, utilities up 1%, technology up 1%, communications up 1%. It was a bullish day on Friday, kind of offsetting that.
It was a get some back day.
Yeah, it was. So not a lot to read here on that get some back day. But on the week, Mark, technology, which had been the forgotten child, It has kind of been off the radar, just kind of ranked right there with a lot of other spaces in the market. Last week, technology is up 2.69%. Now, obviously, that's the Nvidia standout performance against the backdrop of a general market that was fading a little bit, especially following the PMI numbers on Wednesday, kind of that expectation coming in, Thursday. In the last month, what do you see? You see tech and comm services. Those, when you see tech and comm services has the Meta, Netflix, Google. Technology has Apple, Microsoft, those Nvidia, and so on and so forth. Those are the two areas of the market that are really kind of carrying the rest of the market right now. Utilities has had a really good backdrop in the last month, gave up a little bit this past week, but in general, utilities has been pretty good as well. But is the tech trade back, meaning is technology going to carry the market? Meaning, is
Well,
it?
yeah, and yeah, let's clarify what we mean by that. It's like, for me, it means, okay, you tell me what it means for you, and I'll tell you what it means for me. For me, it means like, oh, where do I feel the safest? Right? Because I'm a cash flow guy, right? And so stability is the most important thing for a cash flow guy, right? Because I'm not hitting big home runs. I'm looking to hit a lot of singles. And it, for me, is like, oh, best companies, best trends, best momentum, best earnings stories. Yeah, as far as sector, it's the safest for me. Give me the generals from that perspective. What about from a delta, momentum guy?
For me, it's basically, you're talking about two things here. Number one, the generals of technology basically having broad shoulders and carrying a lot of the other areas of the marketplace. That's when Max 7 typically outperforms the market, and that's when you start to see the breadth contract, not expand. And so the breadth meaning a lot of people will flock to technology for a different reason. Either one, for the growth side of the equation, as they want to attach themselves to Nvidia and the downstream halo impact on Nvidia, or two, kind of what you said, and I know it's a weird thought because we're talking technology, but when you're talking about safety in the marketplace post-pandemic, I don't know how you can describe anything as more safe than the generals with large moats.
Yeah, no, if interest rates are higher than longer, these companies they're not reliant on financing to survive and to grow, right? That's the central argument for it.
Russell 2000 companies are, right? Yep. They're very sensitive to the interest rate conversation. You know who's not? Apple. They don't really care about the interest rate conversation. Google doesn't really care about the interest rate conversation. Amazon doesn't really care about the Nvidia. Does Nvidia care one iota about what the interest rate is out there? No. And so as long as you got the generals spending billions and billions and billions of dollars in R&D, and as long as that's going to the flagships of Nvidia and like companies, then you're going to have that large moat conversation out of the generals. And so to me, it means two things. Number one, the downstream growth impact on the Nvidia AI trade. And number two, which has not sparked again as of yet. It might spark in a round two here, but that's a technical conversation as much as it is a fundamental conversation. And then number two would be the safety moat conversation that the generals provide to the market in times of a little bit of, I don't want to say economic concern, because it happens when the market gets spooked for a variety of different reasons. Traditionally, for example, when I was a young lad in the market, they taught us the market would flee to food-based companies and utility companies and guns and ground and gold. And I'm like, yeah, this is not your grandfather's market any longer.
Yeah, it's not even your father's market, right?
They flee to Apple and Google and Microsoft.
That is a dynamic in modern markets that you have to understand.
And it's unique against what we've been taught. It's unique against what we think from a consumer perspective. But at no point have we seen the monetary supply increase like it has in as short of time historically as it has. And so it has created a weird environment for that.
Yeah, growth and safety rolled into one. Now, one of the things that you see on that heat map,
Matt, the question though, because I haven't answered the question.
Oh,
to answer the question, yes, I do believe the tech trade is back from a leadership perspective. and technology. I'll leave the entire sector rankings to the newsletter, but technology is the number one ranked sector right now.
There is, in that last few minutes, that is the difference between the two brothers. We both come to the same conclusion. I'm like, yeah, these are the biggest, baddest ass companies. This is where I want to play. There's my analysis. Matt leaves this analytical backdrop storyline to get to his yes. And that's us.
If you want to understand why I go through so much detail, is I am an educator and I like to provide context to the argument to help our communities understand it.
Yeah, and for me, it's like screw food-based companies. I trust Google.
I think they both work. I think
they do. There's a good blend there. There's a good blend. Now, one of the things we see on that 1 week performance, Matt,
you work better on Twitter with that than I do. Let's just
is a lot of red, right? Because Thursday was a really interesting day. You had and give me RSP or the Dow to illustrate this day to its full capacity. Just give me a good old daily chart where you had Nvidia come out with earnings. Rockstar, everybody knew. Market gaps up a little bit. And then the floor just fell out in the short term. Now, the specific trigger for that floor was PMI numbers came in a little hot. They were the big economic report of the week in what was otherwise a really, really light week. It was a light week on the economic front. There wasn't a lot going on. We had highlighted in the newsletter and in this podcast that from an economic, it was PMI on Thursday. They came in hot. Economic good news is bad news. And then you saw a disproportional response in market actions where intraday momentum just carried over. And it was one of those days where the heat map was hilarious on Thursday in the sense you had Nvidia big green.
Elfin Nvidia. You had one massive green and one small green. Everything else is sea of red. And Matt, this is my take. It just was one of those days, right? Now, were the PMI numbers so important that they triggered? No, let's call it what it is. But it was a reminder that how sensitive, and I talked about this in the economics, how sensitive the market is to the interest rate conversation right now, right? Like it is.
And that's what Thursday told me is like, oh, this market is really sensitive to that conversation right now.
What's more important to the market, the interest rate yield conversation or Nvidia's Rockstar earnings report?
What is more important to the market? What's my time frame? Thursday. Well,
it's yields. It's always yield.
Yeah.
And yeah, I do think obviously Thursday's price action reminded you of a CPI day, right? Where you get a massive volatility and the algos kind of take control of the price action. And that's certainly what happened on Thursday with the good news is bad news beat on the PMI numbers. But I'll tell you, it was fascinating to watch that type of volatility, and it just got more volatile throughout the day. And you certainly got to be a little bit concerned about that volatility because they can spiral out of control in the short term. Now, we are sitting at support levels in a lot of the indexes. It's going to be interesting to see how the market navigates that this week. But, basically how I discussed it in the newsletter was you got to be ready for confirmation on both sides of the ledger here. Support, certainly you're always going to bet on support and you're always going to bet on the trend, but you have concerns right now that the market might give back a little bit here. And, you're with RSP, you're setting on the 50-period moving average. You've had a little bit of a dose of volatility that was unexpected. And so you got to be a little bit cautious with that. I'd like to see support hold early in the week. I do believe that this does result in an increasing in support. I do think we see the continuation of the short-term bullish uptrend and perhaps put a lot of pressure on overhead resistance to finally end in a breakout. But regardless of what we're seeing in the short term, retest against all-time highs after a pullback, and I wrote about this in the newsletter last week, have a rich history of seeing short-term consolidation as it does retest that all-time high. And so right now we're kind of in that zone of that all-time high. We're seeing some general consolidation, but you are seeing more volatility in RSP than you're seeing in the actual ES. And when you're seeing more volatility in RSP than what you're seeing in ES, it's because the generals are holding up in comparison to what RSP is doing. And so that would go to a little bit more evidence to the tech trade being back here.
Yeah, I know. And one of your calls in the last couple of weeks, and it's been a good one, is like, listen, I mean, clear back. You and I were both on the, all right, yeah, this thing is going to test all-time highs, hit there. But you were very adamant about, like, listen, and this was based on history. Expect this thing to have bulls to have to earn a sustained break here. That it was going to be a test. It was going to maybe even have a touch of volatility. It wasn't just going to be smooth selling, and to expect consolidation. And that sounds like that's where you're still at right now.
Well, I thought Nvidia certainly could have been that catalyst to propel a breakout here, and it tried. It did on the overnight action on Wednesday after Nvidia reported earnings. You saw a breakout at a very clean 5350 trigger. Obviously, Thursday morning you saw that Nvidia impact, and PMI numbers kind of lead to a fake out, but. You certainly did, but when you fake out on an intraday time frame, regardless of the catalyst, that just tells you the market's not ready for prime time. And so, yeah, I'm still on. I certainly did believe the Nvidia could have been a catalyst to propel the market to a breakout. It tried to do it on the overnight action, came right back down during the cash open, and so it didn't. It didn't do it. What we did see is increasing volatility, and I don't think we're there yet. But you do have some slight concerns over the shifting volatility at the top end of a trend. You do have some slight concerns that you gave up the 9 EMA, and you have some slight concerns that you're seeing increasing volatility out there. I want to see it kind of breach that 50 that 20 period moving average a little bit on the daily chart before you see that confirmation, because you could see just the standard pullback here. But you do have a little bit of concern on the shifting volatility. But in general, yeah, I'm still on the consolidation train here, waiting on a breakout.
Yeah, I know. And we're heading into a light 4-day week from a anything happening standpoint. You do have inflationary data out on Friday. And that becomes the no-brainer biggest event, right? Like, you don't have to be an expert. You just have to be aware of the main storyline of rates and inflation to know that this is the event this week. And so you can see, Matt, like 3 light days and then something exciting happening on Friday, one way or another this week. Couldn't you?
Well, yeah, but I think, yes, you could, but you have to also give the context of what happened last week. And you have to think about, can that repeat what we saw this week? And so simply because something occurred last week does not mean it's going to occur this week. And what I mean by that is it wasn't just the beat on the PMI numbers that drove the volatility. That was not it. That was the catalyst that sparked it. But what you really had in that moment was the dollar spiked, yield spiked, because the market removed, from a probability perspective, one interest rate cut from the back half of 2024. So it was the actual updating of the market removing an expected rate cut that triggered the volatility. It wasn't just the beat on PMIs itself. We see economic beats, economic misses all the time, but it was when the market finally, after 38,000 speeches of saying you're not getting an interest rate cut, positive economic data is suggesting over the last couple of weeks you're not getting an economic cut or a rate cut, and then it's almost like the PMI numbers were the last nail in the coffin of that rate cut.
That's a good way of phrasing it. Last nail in the coffin, right?
Yeah, and so it was like just that. It was like that moment in time when the market accepted the fact that they're not going to get what they want. And so is a beat on any of these economic reports this week going to create that same environment that caused the market to reduce their expectations, which as of right this very second the market's expectations are not exactly fairly high for a lot of cuts this year. In fact, 20% of the market doesn't believe we're going to get a cut this year. 60% of the market believes we're going to get, or 41% of the market thinks we're going to get one cut this year. The vast majority, around 72% of the entire market, think we're going to get 1 to 2 cuts this year. And so those numbers have had to come down over the last week. And so, in my estimation, I'm not sure you're going to be able to create that same type of environment where the market next week says, "Oh, we're not going to get any cuts this year." Right? That's not what the Fed is.
You would have to have, yeah, that's great. But what about on the other side? What if you get a, inflationary number that is just bulls are celebrating and popping
Ready for a
champagne.
53.50 breakout.
Yeah, I mean, it's right. I mean, that's what this week feels like it's set up. Kind of a slight bullish lean heading into that Friday with, just knowing that, just for the reasons you laid out, that, well, you're already down to one cut. The Fed has said hikes aren't coming. That's one thing they've made clear. They've been trying to talk back cuts, but they haven't been pounding the hikes. And so it would take a big inflationary scare to spook the market here, wouldn't it?
Yeah, I think so. I think so. And the PCE report is not the report that typically does that. It's, in my estimation, it's an important report. It's the number one inflationary report for the Fed, but in my estimation, it's the fourth most important from a volatility perspective to the market.
And if you get something reasonably in line, I mean, it looks like you could be heading into a period of chop, right, in the markets, right, where you're just consolidation, right? Consolidation, which has been your base call for several weeks now.
I do think a catalyst is needed to break the market out. That catalyst can come from a variety of different places. Obviously, a miss on inflation is one of those.
Yeah, no, and so the reduction of those, as you mentioned, sent the dollar up, sent yields up, but commodities started selling on Wednesday before the volatility hit basically everything on Thursday. And, you'd seen the dollar rise steadily during the course of the week. That big green candle on the dollar on Wednesday was the largest move, bullish move, set something off on commodities, where commodities started selling at the top of the chart on Wednesday. What do you make out of the dollar here? Because, and I hate it when these charts have any importance, because it adds a layer of complexity, but they are charts that can be very important. What do you see here on the dollar right now?
I see on Wednesday we had the biggest day in the dollar we've had in the last 3 weeks, and that explains to me exactly why we started seeing the pullback in precious metals. I don't think it's too hard to understand.
Yeah, and not just precious metal, you saw it in copper as well.
How many times have I talked about the dual-pronged approach of a bearish retracement on the dollar and a pullback in precious metals? Like, that's 2 + 2 = 4 to anybody in the commodity precious metals environment. So when you see the dollar forming a bearish retracement, that's going to put pressure on the precious metals environment. And then as the volatility went up on the dollar, and you started to see the dollar go up and up on Wednesday and Thursday, that put even more pressure on the precious metals. But the ultimate question you have on the dollar is, did it reverse, or is this just a retracement? And I think the price movement on Friday suggests that this is just a short-term retracement, which tells me that as long as the dollar stays underneath this 20-period moving average, we're looking at pivot actions in the precious metals market this week.
In fact, that has you froggy. One of the things you highlighted in the rapid fire was on silver, that analysis, and that was the reasons, right? Like, because of multi-asset analysis, you could see some quick pivots potentially here.
Yeah, it's the relationship between the inner markets, between the dollar and its relationship to other asset classes. Well, within the precious metals market, they have a divergent relationship, which means they go opposite of one another oftentimes, not all the time, but oftentimes. And so it's not surprising that we're seeing a bearish retracement on the dollar, and in the same time frame, we're seeing a little bit of a slowing momentum, bullish flag on silver, and it's not surprising we're seeing a little bit of additional volatility on gold. But if you're of the opinion that that's a short-term retracement on the dollar that's going to get confirmed, and the bearish retracement, and it's a short-term bullish retracement on silver, then I do think you got to be in the mode of looking for a pivot specifically on silver. And I do think it is silver this week. I mean, you got a couple things in the precious metals market. Copper's forming a little bit of a bullish retracement in a go or don't type situation against that 20-period moving average. Silver is in a momentum bullish trend, sitting at the first level of retracement analysis, the 9 EMA on the daily chart. You could definitely see a really good trade lined up as long as you stay above $30 here in the short term. In the longer term, anything deeper would also be playable on silver. Two numbers I want you to keep an eye on are the exact same two numbers that I asked everybody to keep an eye on before the breakout, and that's 29 and 30. Keep an eye on the pullback to 30, reestablishing that as a new support level. Keep an eye if the 9 EMA combo with $30 does not work out. Keep an eye on that retracement going down to 29, which is right around where the 20-period moving average is. Anytime you're tracking the depth of the retracement, and Coach Frank wrote about this and talked about this in the technical portion of the traders report this week, you track the depth of the retracement, and there's 3 levels to the depth of the retracement. And what you're doing is you're tracking those levels and then the creation of a pivot within the when the market is at those levels. And so right now, silver is staring at the 9 EMA. It's slightly north of that all-important 30 number. And so, yeah, I do think silver's on the radar this week because you got momentum and trend, you got a momentum pattern, and retracements for newer traders, retracements can be frustrating sometimes because a lot of times you'll get stopped out, or you don't know when to get back in. Retracement analysis is a technician's dream, quite frankly. We love retracement analysis, but the retracement analysis is certainly more complicated than breakout analysis, because on a breakout, you take eBay for example this week. On a breakout, it doesn't take the advanced technician to be able to identify a breakout. You're breaking out of something, and on eBay it's very, very clear.
Yeah, I mean, it's like, oh, you were here and now you're there.
Now you're breaking out, right? You're breaking out. Well, on the retracement side of the equation, it's a little bit more complicated because you got to take into account not just one number and whether or not the market achieves that number, but you're looking at the 3 different levels, and you're waiting on pivot confirmation, which is a little bit more complicated than a standard confirmation on a breakout. So it's a little bit more advanced on the technical side of the equation, but that's why you get a higher return versus risk ratio in pullback analysis versus breakouts.
Yeah, no, that's great stuff. Let's talk oil, and then we get to Bitcoin, and then I want to have an interesting conversation that ties in Elf Beauty to an interesting stat that you shared with me and shared on the halftime report. Well, we'll tie those together. Matt, when I look at crude oil on the daily chart, I'm like, that's ugly. When I look at it on the weekly chart, I see like, oh, that's a pretty good cash flow chart. That's a pinch waiting to happen. It kind of looks boring, and boring for me is like the name of the game usually for cash flow. I'm like, oh, if that's boring, I'm getting high premiums, I can do something. Matt, you've been talking for 4 or 5 straight weeks, 200 weekly, how there's a good chance that we do that dance again. And right now we enter crude oil with moving averages on top, moving averages on bottom. I mean, my goodness, it seems like we live in that environment with, a few exceptions here and there of momentum. What do you see from a technical perspective in oil?
I see an interesting support conversation that we're going to be having over the next few weeks, but just to be very, very clear, multiple times we have tested that 200 weekly moving average. Multiple times we see wicks underneath, and multiple times it takes a little bit of time for it to get dialed in. And so this is not a quick swing trader conversation. This is more of allow crude oil to go through reversal analysis on the daily chart. And if there's one thing I know we will do, is we will track that reversal for our community at Tackle Trading, because if you can drill, all pun intended, if you can drill a bullish reversal on crude oil off the 200-day moving average, and you can catch one of these trends in energy, you'll start to understand why we anchor so much against energy stocks over the last few years. Regarding energy's had a tough week. In fact, in my estimation, one of the worst sectors this week. And I'm not just saying it from a price perspective. I'm saying it from what you were looking like going into last week versus what you look like at the end of last week. You look like you were breaking out and confirming out of a symmetrical triangle last week. And now you look like just an absolute fake out with nothing but lower prices in front of you. You got to be a little bit patient here on the energy conversation. It's going to go in tandem with that reversal conversation in crude oil. And so I do think we can be patient here. And while we're talking Nvidia and some of those growth opportunities in the market, while we're talking about general cash flow strategies, we're going to allow energy to redevelop, reset up, and get ready for I don't even know how many rounds on energy we've had over the years here, but we're gonna sign up for that next round. I just don't know where it's gonna come from yet.
Yeah, our community did very well on the last energy move.
Oh man, we nailed that one. But we talked about
and then volatility shifted, and this is what traders do. Here's the move, volatility shifts. Let's back off. Wait for the next one. Here we are 5-6 weeks later, right? But you catch these moves in energy. It's worth spending a few minutes discussing on a weekly basis just to see where we're at, right?
In standard average time, I would say we're a month away from bottoming action. That's about how long it takes in consolidation at the low point. But you got to be ready. I just think it's going to take a little bit more time than 3 or 4 weeks underneath the 9 EMA for this to get developed. I've tracked these reversals live in the halftime report, live here on the podcast multiple different times. People that are veteran listeners of Tackle Trading and the Trading Justice podcast, they know exactly it's not a swing trade when we're talking about the 200 weekly. We call it grandmama for a reason. It's a slow moving beast. Let's be patient as we develop underneath right above the 200 weekly, right underneath the cluster of every other moving average.
Yeah, no, and let's I love markets, man. I love talking markets. We're blessed to do things that we would be doing anyways as a profession. I'm just very grateful, very grateful. Be grateful on Bitcoin to get a breakout. It seems like that's where we're at. And you're not so far away that you can't talk about those things, right? You got rising moving average, you're still above the 9. It's Bitcoin, you're only 5% underneath that breakout level, maybe a little bit more, but I mean, that's kind of where we're at right now, breakout or bust right now.
I know that's kind of what your take in the newsletter was. I had a slightly different take than that. Yeah, from a general Bitcoin perspective, I do think that's what you're looking at in terms of just wide, volatile neutrality, basically wide neutrality. But you're basically dancing a wide range here between 60K and we'll just call 74, 75K. Right now you're at 69K. And so, yeah, you could easily make the argument that you're just in the middle of the range. There's nothing really to see. There's nothing really to do. And I certainly do agree with that. However, for the aggressive trader, I do see a directional edge in the short term within this neutrality. And this is not something you always see, but if you were like, for example, we put Bitcoin IBIT on our stock report, traders report last week on the breakout of 38 with the target of 42. This week, you went up to 40. So you got $2 of appreciation before you did a snapback on Thursday with the marketplace. But where that snapback came into is right at 38, which is the old pivot point in the short-term reversal. And so you have, in the shortest time, for the most aggressive style of trader, the ability to get a pretty clean bull flag based pattern within the neutrality that would be a front-running situation going into the larger, more important breakout. And when you're talking about that larger, more important breakout, the one that you appropriately identified was that 74, 75 level on Bitcoin. Well, on IBIT, which is the BlackRock ETF that we track, that would be 42. And so I do see a short-term edge with a front-running mentality, that because what you can see in Bitcoin on breakouts, guys, is all of a sudden it's up 10% and you're not even up out of your bed yet. And so if you're looking on the
we see some version of that all the time, don't we?
Yeah. And it works both ways. But if your intention is to try to catch the breakout, and you know what can happen on a Bitcoin breakout, this is the technical environment that you would look for to do what's called front running. And when you're front running, you want a clean area of, you want an increase in support going into a clean resistance breakout. And although I wouldn't argue that it's the cleanest environment, I would argue that this is the only technical edge you have in front of that breakout. And so if you're not going to do it now, I'll kind of say that the same way you said last week. If it's not now in this situation, then when? Well, if it's not now, then it is absolutely waiting on the 42 breakout. But I do see a scenario where you could front run that. But again, that would just be for the ultra aggressive directional trader.
Yeah, interesting. Very, very interesting. I want to transfer. We're going to probably be the only people in the entire history of the financial markets to transition from Bitcoin to ELF Beauty. That's a first, right? That's a first. But little anecdote for those at home. Matt and I were talking on the phone on Wednesday. NVIDIA reported after the bell, right? I call up my brother, like on these big economic reports or big earnings reports, just to talk shop. And like, what you think, what you do? And we ended up spending more time on ELF Beauty because ELF Beauty immediately started selling off after their earnings report. And my brother was pissed off. Because my brother's a numbers guy. He's a quant guy. He's left brain nerd, right? And he's like, these are really, really good numbers. And if the market has the audacity to sell this off, this is going to create an opportunity. Like, but talk about ELF Beauty. And then I want to transition into our final topic, a little poll, tie the two together.
Yeah, ELF Beauty kind of, number one, I like the company. That's number one. Number two, it wasn't understandable that ELF was sold on the initial release of the numbers. It was the logic I started seeing people make regarding why ELF was selling off on the raw numbers. And I was just like, nah, you guys didn't listen to the report. You didn't read the report. You did not understand their guidance update. There was some misunderstanding, I will say, of ELF's report. ELF had a mixed report, number one. They destroyed their EPS. They had a great revenue handle. They made their first $1 billion in a fiscal year that ELF had ever done. And so you're talking about a pretty successful story about ELF, achieving its first $1 billion year, beating the EPS 48 cents against 32 expectation, a 50% beat there, revenue beat against the expectation. Revenue was up 71% year over year growth. And in a quarter where I've complained about revenue a few different times, that
many times
really stood out to me. The problem with ELF was they decreased both EPS and revenue guidance. And for people that just look at those raw numbers and do not try to provide context on the wrong numbers, but the only thing they see is a decrease in both EPS and revenue guidance, they're going to lump ELF in with the rest of the beauty space that has been in general struggling. And so we're going to hear from Ulta Beauty this week, for example. But in general, over the last few months, 6 months, 7 months, we've seen the beauty companies struggle from a growth perspective.
And we've seen luxury too, like, because Lulu, is not a beauty company.
Lulu's down 60% off its size.
But Lulu is a luxury goods,
100%. Nobody wants to spend $300 on a pair of stretch pants right now.
Well, they have in the past, they just haven't in the last, they just don't right now. And we're going to talk about that here in a second.
Yeah,
But
but
you and I, we're both fathers of teenage girls, and so we both know Elf Beauty products, and Elf Beauty products are, you go to Walmart, and I remember the first time I ever, my daughter, because there's that day, right, where they take you to the store and they're like, I want to go to the beauty aisle, and you're like, I haven't been here before, right? Or I haven't been here for a long. And we go into the Walmart, the super center, and you see Elf Beauty products freaking everywhere,
yeah.
like just like dominating the aisle space,
Mhm.
in the Walmart super center. And I'm, just like,
And
it's
it's
just
not
like
just that. A lot of people will associate companies that deal with Walmart as cheap products. And Elf does have a cheap beauty product from a cost perspective for the consumer. But I'm going to tell you, those teenage girls love the product. They are
they're
fans of the product. They love the name of the company. They love everything about the company. And so, yeah, they got a good loyal brand following, and it's going to grow in my estimation. And so I have a very positive opinion of the company. It's my favorite company in the beauty area of the market. But my point on their guidance was this: when you're talking about Elf's guidance in the backdrop of what's happening in the space, I think it's understandable that Elf dropped their forward-looking guidance. But in the conference call, it was literally stated that that guidance that Elf provided was extremely conservative, extremely conservative. And once they made that comment regarding the conservative nature of their guidance, the market reversed course extremely fast. And so, Mark, that call you're talking about was literally 5 minutes after Elf reported, and they were screaming down on the drop of forward-looking guidance. Once that was discussed in the conference call, the market went right back up because, again, think about the numbers, for example. Elf's guidance is not a problem. Elf's guidance is positive. They dropped it a little bit from a conservative perspective, but nothing in line with what the space is going through right now. They're still a rock star in the space in comparison to other beauty companies out there. And so when you look at Elf, they reverse course. And so, yeah, I complained a little bit because it gapped up and I didn't get my 200 SMA test, which I was going to market order there. But so I complained a little bit, but love the company, and I'm
dude,
not.
it was like my brother was me for a minute. Like he
I just want
complained
to get deep value here.
about the numbers, and then he complained that the market, he complained that the market was being irrational, and then he complained that the market was being rational.
Uh-huh.
Like, I was like, oh, I
It's
do
like,
that
this
kind
is
of
an
stuff all the
irrational
time.
response, and then like the next day, I'm like, they got way too rational, way too fast. Like this is not okay. But I also think the market got it right
I
ultimately
do
on
too.
Elf. I think they got it right. The market, a gap down would have been an opportunity. A gap out, we're gonna have to wait on a secondary pattern here. There's no doubt about that. But once again, just when you come over to Elf and you're thinking about Elf, the company, and you're looking at other household products in this space, you're talking about Procter and Gamble, Colgate, Estee Lauder. I do have a positive opinion on KView if you can hold that 19 handle, but from a fundamental perspective, I don't know them that well. Elf to me is better than all of these companies here, like by a mile in terms of their growth numbers. So I'm a big fan of the company. I think the market got it right, and ultimately, I do think if the guidance is conservative as Elf suggested, that the raw numbers will win out here. Secondary pattern makes a lot of sense. Either a pullback to the 50-period moving average on Elf, clean up $200 and get a significant whole number breakout. Looks really, really good on Elf as well. But Mark, I always have a little bit of more concern about the retail side of the equation when these three companies struggle. Elf is one of them. Okay, Elf is one of them, and these are off the beaten path. Elf is one of them.
This is not your mainstream
No.
XRT, Amazon.
These are off the beaten path, but they have very rich consumer followings. They got amazing brand recognition. Academy Sports has been struggling, not because of a bad earnings report. They had a good earnings report. They've been struggling just in the consumer discretionary space. Elf, another one that was struggling up until recently. And so when you're looking at Academy Sports, when you're looking at Elf and they're struggling, that tells you something about the consumer, because these two companies are loved by the marketplace. And another one that does report this week is A&F, when Abercrombie, which has been, in my estimation, the most consistent retail stock outside of a dose of volatility due to their earnings last quarter. It's been the most consistent retail stock for a long time now.
For a long time.
And so the combination of like A&F, ASO, ELF, those types of companies, when they're all doing the same thing, running in the bull direction, discretionary is a really good space. When they're mixed, discretionary is mixed, and discretionary is very mixed right now.
Yeah, it sure is. Listen, I want to tie this analysis into an interesting public poll that was held that you brought to my attention on the halftime report this week. Talk a little bit about this poll, and then we'll have a little conversation on it.
There was a Harris poll that was released earlier this week that basically polled people regarding their understanding of the economy and the marketplace. Now, of the poll, basically 56% of the people that were polled, this is a legitimate poll. I want to say it was part of a political poll in general, but you see a lot of political polls, obviously, during an election season. But a legitimate poll here. This is not just something on X or YouTube or something. This is
Harris been around a long time.
55% of the United States population believe the U.S. economy is in some degree of recession. It's shrinking. It's struggling. However you want to describe it, but they did use the word recession. So 56% of the people in America believe that the U.S. experiencing some degree of recession right now. 49% of the population believes that unemployment, which is at a 50-year low right now and has been the number one reason the economy has not went into a recession, but 49%, a coin flip here, 49% believe unemployment is at a 50-year high. By the way, like the 50-year high,
I didn't see this part of the poll.
Yeah,
this is my first reaction. What?
Yeah, that one's a head scratcher. Honestly, it is. Like, most people have one or two or three jobs right now to offset inflation.
I mean, that's the joke, right? Like, yeah, listen, everyone's
the problem isn't you don't have a job, you have too many jobs.
You got too many jobs to try to make ends meet.
But 49% of people believe that unemployment is at a 50-year high, not a 50-year low. 87% of Americans say prices of goods and services have increased in the last year. Now, most people will say that one's inaccurate because the rate of inflation has dropped from 9% down to 3%. I'm going to say the Americans got that one right.
Yeah, they got that. I would have
positive 3%, guys. Like, inflation is still going up. I don't care how you want to paint it. Is it getting exponentially worse? No, it's not. I mean, the velocity is coming down, but last I checked, positive 3 is still a positive number, right? So I'm not going to.
I think your math's right there. I think your math's right.
So, what are your thoughts though on the Harris poll here, Chucky? I've seen a lot of people out there around social media and whatnot take a bunch of shots at people on this poll.
Yeah,
what's your thoughts though?
Well, and there's one stat that you shared with me, because one of the things you'll have to be careful of in an election year is that polls are misleading, they're biased. Listen, I did my PhD work in political science. I actually studied this topic of framing of questions.
You and I are deep political nerds.
Framing of questions that you can get the desired result depending on the framing of the question. But what was really interesting about the 56% is how it broke down across political lines, because I think that is critical to understand what I'm going to say after. What was the political breakdown of this?
I want to say 65% of Republicans in the poll believe that the economy was shrinking or experiencing some degree of recession. And in an election year where propaganda is all out there on both sides, right? They're making their arguments. Call it propaganda, call it an argument, whatever. They're making their arguments, and rightly so. Go make your arguments. But in terms of I read somebody, and I can't remember who it was. I wish I could. But their take on that was, well, that's probably because on political programming, you'll see on the right side basically talking down the economy, and on the left side trying to talk up the economy. And I was like, in a political election season, that might make some sense, but let's just not make arbitrary numbers. Let's not make arbitrary arguments. Let's make sure that we have the data to support the argument. And when you look at the data behind the numbers, I mean, 65% of Republicans thought the economy was shrinking. But Mark, 49% of Democrats who watch nothing besides, things about the economy doing good.
They're not out there with MAGA hats, right?
No. And so it was across political.
They're not there listening to Jesse Waters on a Thursday night.
No, not that 49% is.
That 40% is not.
So I just didn't feel like the argument they were trying to make was this was based on propaganda coming from a political perspective, and I just felt that was just a lazy argument, honestly.
Yeah, that's incorrect to have half of Democrats responding. There's something else going on.
Not only from a numbers perspective, it doesn't make any sense. You're basically making a biased argument to support what your opinion is there. What's your take? Why do you think that 55% of the United States population believes that we're in a recession when we're not? Why is it that 49% of the people believe unemployment is at a 50-year high?
Which is not.
Not only it's not, the polar opposite of that one is true. And again, I if you were to poll me and say, is inflation higher or lower than last year? I'm saying higher because that's technically accurate. So I'm saying the 87% of Americans got that one right. But what about the recession and the unemployment one? Why do you think there's such a disconnect between what the economic reports state versus what people believe the economic environment is doing?
Well, we know, first of all, we know the financial literacy in the United States of America is not where it needs to be, right? Most people and it's not just this poll, which is this poll is jaw-dropping on multiple levels, but the financial literacy is low. And that's concerning. It's one of the reasons Matt and I do what we do. We could, Matt and I are two smart individuals that could do a lot of things in life. We want to help teach people. We want to. This is important. This is the decisions you make. So there's that whole, and I'm sure you'll have some comments, and I want to hear your thoughts on that in a second. But I think people are polling what they're paying, right? I think that's what's going on here. Like, Google, Nvidia, they don't give two craps about higher for longer, right? They got the cash, they got all that. But your average person, I think, is polling what they're paying. They don't know the data. Maybe they should, maybe they shouldn't. But they're hurting, right? The cost of things, inflation has been brutal, right? And so I think they're feeling a recession in their heart. They're feeling a recession in their day-to-day. And so they have that negativity because of the impact that inflation has had. Ask somebody in their early 30s that might be looking to buy a home. If everything is fantastic, they're going to have certainly some sentiment, some emotions, looking to buy a home. Right. And so I think there's a lot of, economic data, and unemployment might be low, right? The economy might be doing well. but your average person, or at least a lot of people, according to this poll, I mean, these numbers are just staggering for multiple reasons. I think it's pulled with emotion here, right? Because they're not doing as well as the economy, and inflation has had a huge role, which is, I think why you and I were so passionate for that 1 month period where we did all those inflationary podcasts in a row. What's your thoughts on my thoughts, and what's your own thoughts?
First of all, I think people should take a step back before we criticize the consumer on this one. That's my first thought.
Oh, anyone that consumers that criticizes the consumer for paying.
Come on, they are. It's an easy fodder. It is. 56% of the population believes something is happening when it's not. 55% believe that the economy is shrinking when it's not. 49% of the unemployment is a 50-year high when it's the polar opposite. And I have seen people out there, make light of that. I don't think it's that, because when you're looking at the definition of a recession, even some of the most advanced economists in the world would disagree on the definition of a recession. Now, the textbook definition is 2 consecutive quarters of negative growth. There have been times in the past 15 years where we have had 2 consecutive quarters of negative growth, and the U.S. economy did not officially declare a recession. And so if the powers that be cannot agree on the standard definition of a recession, I don't think we should criticize people who are just simply trying to live their lives, whether we're in a recession or not. Second, it is very widely understood that consumers will judge the economy not by what the GDP report is, or the inflationary report, or the retail sales number, or the PMI numbers. They're not familiar with those things. They don't know those things exist on a day in, day out basis, because they're living their lives. And a lot of times their lives have family and faith responsibilities, community responsibilities, things that are far more important to their lives, their everyday lives, than the debates that happen on a day in, day out basis of the United States economy. Number 3, when you're looking at the consumer, historically speaking, they don't judge it based on those numbers. They judge it based on their experiences from a historical perspective in recessions, and their experiences in comparison to what they're going through right now. And so when you're thinking about the last recession we went through, was the pandemic recession that shut the U.S. economy down, sparked a lot of fear in the marketplace, saw unemployment spike quite aggressively in a very, very short time frame. Oftentimes, the consumers, when they're answering these polls, are not just looking at it historically, but they're thinking about where we're going into as well. And so they might not be thinking, when they're on that phone call with the pollster, or whether they're on an online forum or something, whether, hey, what was the GDP last month? What was it this month? Was it next month? Where's the labor market? They're not going through that. They're thinking about themselves, their family, their community, their environment. For example, if you're sitting in the Midwest and a plant goes down, well, Mark, the U.S. economy might not be going through a recession, but I'm going to promise you the 5 towns that plant basically feeds and puts to work, those people are going to feel like it's a recession for them. And then when you take into account how they, the pandemic, then you go back 10 years ago to the subprime meltdown, there is this muscle memory, Mark, that I've seen this over and over and over again. People that have zero understanding of economics, zero understanding of what the definition of a recession is, but there's muscle memory in going through the market cycle collectively together over the course of the last 10 years, 20 years, 30 years, 40 years, 50 years. There's some muscle memory to that as far as the market goes up and up and up and up and up, the further it goes, the longer it goes, there's an inherent understanding that all good things come to a conclusion. And so there's some concern towards the future in this as well. And so I'm willing to bet that the people answering this poll, number 1, are thinking not just about the here and now, but they're thinking about the here and now in comparison to where we're going into. And their overriding concern of economically where we're going into is probably having a fairly large impact on how they're answering this question. They could be thinking, yeah, the US economy might not be too bad right now, but man, we got a lot of debt. Man, we got a lot of inflation. Man, we got this. They're thinking about the future as well. And in an election year, where a lot of the conversations that are about the future, I'm willing to bet they're thinking not just from a historical perspective of the standard definition of an economic recession, but they're also thinking about the concern they personally have coming down the road. And then your point to, which I think is the number one reason why most people are wrong, technically wrong in answering these questions, but maybe not fundamentally wrong in how they're experiencing it, is based on inflation. It doesn't matter how much money you make, how many jobs you have. It doesn't matter if inflation wipes everything out. It doesn't matter if you have the number one growth market, you have the number one GDP market in the world. You've done so much better than every other country in post-pandemic analysis. All those things are true. All of those things are true. But it doesn't matter to the end consumer if at the end of the day, after every month, they're exchanging their time for somebody else's money just to put food on that table and pay back all these corporations all the money that they made. So the standard consumer has a job, gets paid money for that job. Then at the end of the day, they buy food, they pay their utility bill, they pay the car payment, they pay their house payment. And so all their time that they spend working their asses off nonstop, not in one job, but most likely two jobs, and not in a family of two parents, three kids, they all have a job. That might not feel like the economy is doing great when they have to have their 18-year-old go out and get a job, their wife go out and get a job, the husband get another job, have a second income, have a side hustle. Well, it doesn't matter if the economy is growing at 3% every single year. If you have to have every aspect of your family, your life, your experiences, your time, all simply try to put food on the table and pay the bills, because at the end of the month, you're going to look at your time and be like, I have nothing. I have nothing. It's a waste of time and space. And so that feeling that people have because of the inflation, it's who gives a shit if they're wrong on whether or not the economy is growing or not, if their entire family is dedicating their entire time to simply paying bills, which means all their time and all their money is going to the corporations of America in general. And so to me, this just goes to the issues that inflation and this economy that we are designing and the problems associated to it. That to me, this is more of an indictment of the United States, the design of the United States economy right now, than the actual economy itself. Does that make sense?
It does, Matt. And, I think some of the powers that be are picking up on this. Janet Yellen this week, just a couple of days ago, in fact, we were very critical of Janet Yellen, powers that be, for the gaslighting that they were doing to the American people. We did a whole podcast series on it. She came out a couple of days ago, and instead of the gaslighting, instead of the don't believe your feelings, your lying eyes, she was just, people are hurting right now. They're hurting. Inflation's hurting people. And that was a complete about face from official propaganda. The actual acknowledgement of the truth. I mean, who would have thought that would be a political tactic? But
well, it's good on Janet for saying the simple truth out loud, but good on her for saying it. That hasn't been her message recently, and that hasn't been the message of the Biden administration either. It's been, no, we're improving. You just don't know it yet. And it's like, everybody's like, well, when am I going to know it?
like, I know that message is not resonating with people.
It's a terrible message.
It's not resonating with people.
No, it's not. It's not. There's other messages that would work better there. But again, my general point is this: I understand I could care less if somebody answers the question of whether or not a recession is technically accurate or not. Once again, economists will debate that. Like, I'm not going to blame consumers for not knowing the technical textbook answer to that. And so I'm certainly not going to criticize the consumer for that. I think it's damning evidence towards what economy we're building. Because Mark, in that same time frame when all these people are experiencing all this, the rich are richer and the poor are poorer. That's a simple truth. In the last 4 years of post-pandemic, we put in trillions of dollars into the system, a vast majority of that directly into Wall Street corporations and banks. And yes, this time around, consumers got a token $2,000 check and a little bit of stimulus, and that's fine, but that was a token in comparison. That was a tip in comparison to the money supply that they increased into Wall Street, into the marketplace in general, into the banking system. You want to talk about the bailouts of 2008? That doesn't hold a candle in the wind in comparison to what we did in 2020. And now it's the consumer that is having to hold that check at the end of the day. It's the consumer that has to hold that bag of inflation at the end of the day. It's the consumer that all these corporations who got all this money in PPP loans, all this money gift wrapped to them during the pandemic, to Wall Street and to the banks and to corporate America. But it's the consumer that those corporations and those banks pass on all the inflationary pressure to. So the consumer gets a token in the pandemic, gets an attaboy in the pandemic, gets criticized for not understanding the complexity of the economic environment, and then gets to hold the bag regarding the inflationary for the next 30 years. And so for me, I point to the powers that be, and they probably say mission accomplished on this one. And I say we need new leadership.
Yeah, we do need new leadership. We need new culture. Populism is growing around, not just in the United States, around the world. You look at Europe, you look at South America, you look just about everywhere. Populism is a trend, and there's a reason, right?
Well, call it whatever. People should always support people.
You know, there is a reason for that. Well, listen, diverse podcast, broke it all down. Matt, you mentioned earlier you're on the Coaches Show this week, and for the next 2 weeks, a little 2-part series at Tackle Trading. Listen, my brother, he talk about preparation. Listen, it's going to be a great experience. Not a bad time to sign up for a free trial just to catch him. You're going to talk about earnings. What other thoughts?
Well, I think I'm on the Coaches Show for the next 3 weeks. The next 2 weeks, I'm doing the earnings conversation, and I haven't dialed in exactly the process what I'm going to do for that earnings conversation, but it is going to be very, very in-depth and going to teach people how to navigate the complete earnings landscape. So both from a earnings season perspective, individual trading perspective, understanding, interpreting the data. We're going to have a lot of fun in the next few Coaches Shows for certain. So for the pro members, that Coaches Show Tuesday night, 8:30 p.m. Eastern Standard Time. If you cannot make it, we record every single Coaches Show, so you'll be able to have that at your disposal as well. So definitely get excited about the upcoming Coaches Shows on understanding earnings and navigating the earnings landscape. And I love it, Mark, because we're right about, and yes, I kind of did plan this, we're right kind of at that tail end of the previous earnings season, which is right the same amount of time you start to understand volatility builds going into next earnings season. And so there's a couple different ways to trade earnings. You have earnings builds, and you have when earnings crushes. And the earnings, the implied volatility build happens for about 4, 5, 6 weeks before earnings, for about 4 or 5 days after earnings, it comes out. And And if you understand the options market, you can take advantage of that. And so we're going to have an understanding of volatility builds, volatility crushes, market maker moves, interpreting all the data that comes out of an earnings, understanding what a hat trick is, EPSs, revenues, forward-looking guidance, secondary reports, gapping analysis, you name it. I'm going to teach it all, brother, and we're going to have a lot of fun. So whether it's the more I talk right now, the more I'm going to extend it for the next 5 coaches shows. No, I kid. For the next 2 coaches shows. So I probably
you can do it. I promise you can do it. You got enough material.
I probably do. But yeah, definitely there's not a better time than right now to join Tackle Trading. Mark, really appreciate your thoughts on the podcast here today. And I think that's 2 weeks in a row I got a little bit of a soapbox moment there. I got
dude, there's nothing wrong, dude. It takes so much pressure off of me. Right? Like, you know, so I like it when you're the radical brother.
I got some passion over certain topics.
It allows me to just sit back and theta the podcast.
But this for this week, basically, Coach's Show on Tuesday. We're going to have that earnings conversation. Coach Gino's going to be on the Cash Flow Club on Thursday. Traders Lounges all week long, every single morning for the market. You get any help you need on a day in, day out basis. Honestly, it's a complete trading, not just community, but all the education around that. So definitely come over to Tackle Trading, sign up for a free 15-day free trial and enjoy what all the other pro members enjoy.
Yeah, absolutely. Listen, have a fantastic weekend. And, final thoughts from both of us on this Memorial Day weekend is, Matt and I, over the years, have on hundreds of different times paid homage to the men and women in service to our freedoms. We have fantastic lives. We owe that to individuals that have sacrificed theirs to provide the freedom that we enjoy. And Matt, just give me your thoughts on it as we close up the podcast.
We collectively, as Americans, the freedoms that we enjoy here that others around the world just have not had the ability to enjoy for one reason or another. But yeah, thoughts, prayers, everything. We love our community. We love everybody in our community. Veterans, we have a deep.
It always feels like whatever words, no matter how much from the
I don't know how to say what's in my heart.
Yeah, they always come up short on what you're feeling. And so.
A lot of good friends who served in the military, a lot of great members of our community who served in the military, but I just have a truly deep respect for people of service.
Yeah, absolutely. So everyone have a safe Memorial Day weekend and let us know during the course of the week if you need anything at all. But have a good week, everyone.